Welcome to Power Charting. I'm your host, Bruce Fraser. We have a great show today. We're going to talk about the current markets from the Wyckoff perspective, and we have a special guest, Roman Bogomazov. We'll get to him in just a second, but I want to just make a comment real quick about the new look of Power Charting, the intro that you saw at the beginning, and then also the charts. It's all new format, and I just want to do a tip of the hat to my incredible team of producers, Rachel, Denvy, Eric, who produce the show, and they produce many of the other shows. I could not begin to do this without them. They're amazing. Special thank you to Denvy, who has created this new look, who does the graphics and the PowerPoint backgrounds and all that. And Denvy, you're amazing. Thank you so much for this great work. And so let us get started. So take a look at this when you have a minute. Disclaimer, special guest, Roman Bogomazov. Roman and I have been in the classroom together for nearly 30 years. And he is my teaching partner. He is an amazing Wyckoffian and a dear friend, and he's so kind to come on today. Roman, welcome.
Well, thank you, Bruce. Thank you for this introduction, and always happy to, discuss the markets together.
Well, so we have been doing the classroom for a really long time, but in recent years, we've been doing a lot of webinars, and we have one coming up that is going to, I think, really be special. The 300th episode, Roman, of the Wyckoff Market Discussion, Wednesdays at 3 p.m. Pacific time, coming up here. Can you believe that, 300 episodes?
I can't. It's like close to 6 years, and each week getting together, thinking through about what the market is doing, putting it on the slides, delivering that material, getting the feedback from students, and then repeating this each week over and over and over again. It's been a while, Bruce, but it's been such a great ride.
And it's not repetitious because we just continue to have great markets, interesting markets to always be talking about. So it's all, the content's always changing. And this 300 episode is going to be a big event. We're going to have a webinar party, and we want you to be there. So we invite you to come to this, and to attend. You can go in and learn more about it by clicking on this link right here. And then if you go to the top, you can click right on that blue button. Go in, register. We don't share your information, strictly to register for the upcoming event. And we'll have a special offer for those of you that might be interested in subscribing to the Wyckoff Market Discussion and becoming part of our community. And to do that, go to wyckoffanalytics.com, and you can see all this, read more about it. And there's also lots of free content there on Wyckoff, the Wyckoff method, and the different content contributors on the website, which are an amazing group of people. Roman, thoughts?
Well, I'm looking forward to this event. That's number one. Secondly, yes, do visit our website, wyckoffanalytics.com. Under the free materials, check out the bias game. This is a very, very popular communal tool. It's very educational, skill building tool. And then just explore, the products that we have. I know that Wyckoffians would appreciate this a lot.
And also there's the Wyckoff Communal Watch List, which is stocks that have been contributed and selected by all of the community that they think would be interesting for others to check out and look at. That's an amazing list. So you can also find out more about that. I thought to start, Roman, we would we're going to talk about the market. So we'll really keep going here. But the dollar did an interesting thing here in the last few days. This is UUP. You've seen this chart before, and it shows the right here it shows the market pulling back. This was in 2021 to this uptrending demand trend line. And it touched there at that time. We said it should hold this and then rally. And then subsequently, it made this accumulation structure on a one box reversal point and figure, which we then extended the counts on this, and it went all the way up to 28, which is this area right up here. And it was a pretty bold call, and people were going, oh, the dollar's, you know, it can't rally, it's going to remain weak, blah, blah, blah. And we just followed the evidence of the market. And remember when we talked about this, Ramon?
Yes, yeah, and that was mostly you, Bruce. So all of the credit goes to you for kind of like seeing this. Then we discussed this in the class. Then you brought the PNF. The targets of 28 made a lot of sense just because of COVID high there in the dollar, and you know, it just looks like just a very, very great call.
So here we are as of a week or so ago, and you can see that we went right up and touched the 28 level, which is that right at the area of this high close on that high bar back from early 2020. And it touched that area. So it has fulfilled that count. And notice how it did it is it went into an accelerating climactic event where it went up. Looks like some form of climactic exhaustion, not unlike what happened over here, not unlike what happened over here. And also this has a climactic quality to it. And here we are. So Ramon, your thoughts?
Yeah, well, I think, you know, now that we've reached the target, now that we've reached this resistance level, what would Wyckoff say? Stop, listen, watch what's going on. So we're expecting some kind of, you know, stop in action here. That's what I would be thinking. But I guess my question, Bruce, here, you know, with the dollar coming to this target is, how does the stop in action, a possible stop in action in the dollar, is going to influence other assets?
Well, normally, my experience is that precious metals, gold in particular, tends to move opposite of the dollar. Dollar strength, gold weakness, dollar weakness, gold strength, and that gold has been relatively weak in this recent environment with that big climactic run in the dollar. And I wonder if the dollar now let's say it stalls here, built some kind of a cause for a future move, either up or down. We don't know at this point. But if that happens, what will be the reaction of precious metals to the change of character in the trading of the
and it looks like the dollar, as we've discussed it, you know, this Wednesday, is starting to move up. We are seeing the stop in action. We saw the test there. We're seeing a reversal bar today if it holds. So it's a very interesting position in gold where actually, just FYI, I've been adding to gold today with an anticipation that we're going to have some kind of rally. Silver also looks somewhat interesting out of the spring position. And then also the bonds starting to look interesting out of the oversold condition there. All of that, guys, gold, silver, TLT, you know, as the bond representation. We will be discussing with Bruce next Wednesday on May 25th in WMD session, which is a complimentary session. So come listen to us.
That's why every one of these episodes is so darn interesting. I'm going to be there. I'm excited. So here we've looked at this chart. This chart's a week or so old, May 10th. This is the CRB, which has been on an absolute tear. This is the 10-year yield. And this, just for orientation, is 1980-81. This is all the way back in the early 1960s. And you can see that interest rates were going up during this period when the CRB was effectively going sideways in the trading range. Didn't start to launch until 71, 72. And then it really took off, but interest rates were already somewhat elevated. Very interesting. Well, this time interest rates are very suppressed, very low, just starting to come out of this really kind of a spring type event at the low for rates, and now rates are starting to move up more in earnest. And it's actually the biggest rally in rates, really one of the biggest in this entire decline. Ramon, your thoughts here before we update this chart?
Yeah, well, we'll definitely go into the details of the 10-year yield. We're going to talk about the daily chart. We're going to talk about the long-term chart. I'm going to give you like maybe a preview of some of the ideas that we've talked about the rates. I think that the Fed is still on the pace of 2 rate hikes of 25 basis points each over summer. And then I think the market conditions or economic conditions will probably force them to pause with the interest rate. It doesn't mean that they're not going to implement the rest of their plan into 2023. It's just that I'm kind of anticipating the pause. That could give a little bit of a breather to stocks after a potential capitulation event. So all of this we'll dissect, we'll talk about in the next WMD class on Wednesday. So again, this is just a call for you to join us as this discussion requires more time and more details and more chart.
Now here you can see this point and figure chart, which we had put up quite a while ago in 2021, right when this was starting to break out. We just published this. This chart actually is up to date through the 17th, but here's the resistance area at 320. And interestingly, this one box method chart counts up to 260 to 320. And Roman, here we are approaching this resistance level and the point count, and look at the acceleration of rates right into the target zone. Your thoughts?
Yeah, I think again, short-term picture, I think the 10-year is in some kind of smaller trading range right now. So that is reflective of the upcoming pause. But it's definitely possible that the rates are going to continue going up, especially with the Fed policy. And on the long-term chart, I would be expecting it to be, the 10-year yield to be somewhere between 3 and 4, and kind of stay there, and possibly even go down, in 2023 back into the trading range. So I don't foresee something crazy with interest rates. It definitely is not very beneficial to the economy in general. The tightening itself is not very good for the market. So I wonder if the contrarian call here is going to be a pause first, slight continuation, and then actually coming back into the trading range.
Well, let me support that idea here with this. Looking to the lower right, you can see this area. I put a green line across here, which is right at this 3%, 3.2% level, which this peak right here was in 2013, very long term, tested again in 2018. And I wonder, which goes to your point actually, Ramon, that if the market can't stall here because there's formidable resistance at this level, and maybe we just stay here for a few months, maybe into the end of the year, before moving higher sometime next year, because this looks a lot like a base to me.
Yeah, it does. It's just that I keep thinking about the liquidity, general liquidity for the market, and the Fed's responsibility to upkeeping that liquidity in some kind of balance between the growth and the recession. So I wonder if we pause for a little bit for a couple of months, and then we go to 4. And then from there,
which is right there.
Yeah, and then we come back into the trading range, and we basically stay in the trading range for maybe quite a long time. I definitely don't foresee anything like what we've had in 1980s, something crazy like that. I mean, the inflation that we have right now is already, at the 40-year high. So that's a significant inflation relative to the regimes that we have had for 40 years. And we don't necessarily have to go structurally to where we were in 1980s. So definitely still some short-term upside, but on the long term, they will have to still have more liquidity.
Now, let's take a look at the stock market. And this is a chart that Roman and I talked about in the Wyckoff Market Discussion back in 2020. And this is a relative strength relationship of the Vanguard Value ETF to the triple Qs, which I'm calling growth ETF, which is the mega cap growth stocks. This downward stride in this channel going back to 2014 and 2015, where the 3 points that drew the channel were located, that decline all represents growth outperforming value. And so we started to look at this chart when it threw under the channel in 2020 and started to build what appeared to be a base. And so now you've had a rally, sort of a sign of strength, and then a backup to test this 2020 low in late 21, and then a really sharp advance in the value stocks compared to the growth stocks. And so this is a very large structure. Roman, what are your thoughts about this rotation?
Yeah, so definitely we'll discuss it more on Wednesday. That's number one. Secondly, Bruce did such an excellent job indicating this to us back in October, November, end of 2020. Then please note that going into November of 2021, think what the market is doing relative to this chart, right? So the market is under pressure. The market is in the bearish bias. And with that, we see this rotation from growth to value, which is very logical during the bearish environments where the tech is being sold much faster, with the interest rates going up, influencing the growth stocks. So they are being sold much, much faster. I would be thinking that depending on how the market capitulation unfolds, whether we stop here or whether we continue to the downside. And again, something that we'll be discussing on Wednesday a lot. If we have some kind of capitulation, I already see some elements where some of the technology stocks or some areas in the technology sector are being attractive to institutions. Those are selective areas. Those are not necessarily like a broad buying that they are having. But if we have a more general capitulation where there is more to the downside, obviously tech stocks specifically will have some interesting value to institutions. And this relationship might actually change, but we need to go through the process of the capitulation to get there. So all of this we will outline in our class on Wednesday. So come join us, watch.
It's a fascinating nuance, because I could totally see this ratio pulling back to the declining channel, upper channel line, and pulling back, which would be a return back towards growth, and taking a number of months to do that potentially, and then continuing on maybe at a later date. So this completely makes sense to have some kind of a pause and a pullback in this relative strength relationship. So that's a very interesting thought on your part. And the other thing to keep in mind about relative strength is both of these indexes could be going up, or both of them could be going down. And the line itself just represents the outperformance of one of the ETFs to the other. So both could be going down, one at a lesser rate, and that's going to show up in this, or they could both be going up. So keep that in mind as you look at these. And with that, I think we should just get right into the market, Roman, and talk more about some of these stock indexes. And I'm very curious about your perspective, say here on the Nasdaq 100 mega cap growth stocks.
Yeah, so fascinating chart, just because it shows us not just the overall directionality of the market in general, but also the rotation characteristics through Nasdaq, through technology stocks. And we see in everywhere just weakness, weakness coming in November, December of last year, where we can't continue to the upside. The rally in mid of December is not creating the new high. Then we have a sign of weakness, last point of supply, and off we go into the low in January of 2022. That creates another trading range. Within this trading range, in the middle of this trading range, you see how the price spent some time below the support. That's an indication of weakness. Another indication of weakness is the best rally that we actually called really well. That starts in the mid of March and goes into the resistance, but cannot produce a significant commitment to the upside at the level of the actual breakdown of initial breakdown to the downside in
Which is
January.
this area right here.
Yeah.
Yeah.
And that is also an element of weakness, even though this was the best rally. Also behind that, characteristically, the volume is declining, so there is less buying. And then on the way down of this rally, what do we see? We see the expansion of the result where right now the current reaction is the largest reaction in this whole formation, where we see that the supply, or rather selling, is still increasing in the volume signature. And we're seeing that each breakdown to the downside has some kind of intensity, and the selling intensifies. Even the most recent rally that we have had last week that comes to the previous breakdown attempt is negated, and was negated yesterday almost immediately. So there might be some kind of idea of this as being an oversold condition, which I should note that in the bear market, you are going to have a lot of oversold conditions that are going to be broken to the downside. So just keep this in mind. But let's just assume that, you know, maybe we're going to have some kind of rally from here. And if we are going to have a rally from here, it's probably going to retest the 13,000 level. This is where the previous support came. So this becomes the resistance. And that's right here. It still would be in line with the idea of the bear market. So so far, the definition of the bias is to the downside. Yes, we're in the oversold condition where we could potentially rally, but we could also just break to the downside. So until, Bruce, I see something very distinctly bullish in the behavior and in the result, which is being then confirmed by the reaction, which is maybe you know, of bullish qualities as well. I'm not changing my bias from the downside to the upside. Market has to prove itself. If we are, you know, thinking, you know, is this the time to buy or not? And mentally, we should be staying with the trend. What is the trend? To the downside. And that's how I think that we should be thinking about the market, at least for now.
Fantastic. And of course, we can look at the, we can see here in this break, look at the gaps that come in right off the test of that climactic peak right there. And then just kicks off just this wicked decline, which is really comparable to this one in terms of just the intensity. This is more intense, I think. Mm-hmm. So I want to just have you, in the couple minutes that we have left, is I just want to show everybody this just as a view about unfortunately, I can't shrink this, but this was, and this is very short term. This is a 2-hour Nasdaq comp chart. But here is the low that was made here recently with an acceleration. And notice how the advanced decline on a 2-hour basis, very short term, is already walking uphill. This decline, which was that really steep decline we had on Wednesday of this week, came to a higher low than this. And so I'm wondering if we're not seeing the most nascent early clues of green shoots. And I want to clarify this, because green shoots means that we may be setting up for a rally that goes to where Roman was talking about, this prior resistance, old support being new resistance. Maybe there is the potential to get a respite from this near-term weakness at this test of this low right here. So I'm going to watch that really closely. I think it's way too early to tell. And these green shoot structures can evaporate very quickly. So we just have to watch the market literally day by day. So with that,
I wonder,
go ahead.
Bruce, here, with the definition of the market to the downside, and because like I've been shorting the market all this time, since December or January of this year. And I wonder if the continuation to the downside and the short-term rally that is kind of indicative of that breadth could be, instead of a higher high, a lower high below 12,600. So something where we're attempting to go up and maybe like there is an inability to rally. That would be in line with the short-term attempt to rally, and yet with the longer-term bias to the downside.
Fascinating. This is what we do at WMD on Wednesdays. Come join us next week for our party and 300th episode. And Rahman, thank you so much for being here.
Bruce, thank you so much, and can't wait to see everybody at WMD next week.
You all have a great week. We'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.